Good afternoon. So, I'm Daniel Matilla Garcia. I'm head of research and development at Koris International. Koris is a spin-off company from EDHEC Risk Institute. So obviously we're very research focused. What we try to do is, what we actually do is design dynamic asset allocation strategies for investment managers. And what we're going to be, I'll be talking about today about some of the results of the research that we've done at Koris, applied research that we actually deliver and help investment managers to implement on a daily basis. Before start talking about the actual results of our research, let me say a word about what we believe is a crucial difference between having a dynamic asset allocation strategy as opposed to having sort of static portfolio optimization methods. So what do I mean about static portfolio optimization methods? I'm thinking about techniques such as minimum variance portfolios or maximum Sharpe ratio portfolios, like Markowitz-like portfolios. These kind of investment asset allocation strategies are what we know in the academic literature as myopic optimization program. Even if you're dynamically adjusting for the parameters, your input parameters in the optimization program, like your volatilities and correlation typically, the optimization program will be determined as if there was only one period of time ahead, as if every rebalancing date is like a reset date. Like if you've started to invest at the day of the rebalancing date, and as if the end of the reward was in the next rebalancing date, and then you redo the exercise at every rebalancing date. So this is that's why we call it static portfolio optimization methods. So even if the actual asset allocation is not static over time, it is it doesn't take into account the actual path that assets will follow during the life of your investment. What is the problem? What is the implication of that? The implication of having asset allocation strategies that do not take into account the actual path of the assets during the life of an investment is that they won't be able to keep up with literally non-risk management objective exposed. For instance, if you want to minimize volatility and you're using a static optimization program such as mean variance minimization, you don't know what you're going to get at the end. You don't know if you're going to how much volatility you're going to get over a few months down the road. You don't know if you're going to get the actual minimum variance portfolio exposed, minimizing ex ante, then exposed, you don't know what you're going to get. So there's a lot of uncertainty there. So that's why we think that using dynamic asset allocation strategies is crucial from the point of view of the investor. And I think it's very important as well if you want to build a confidence relationship with the investor, because what dynamic asset allocation strategies, if you implement it on a broad asset allocation scale, what you can do with that is to define ex ante risk management, precise risk management objectives. For instance, what the kind of risk management objectives that we try to develop and to put forward in Koris are the ones that are controlling maximum drawdowns. Okay, so what this kind of strategies will do is that you will set, together with the investor, what is your loss, what is your tolerance for losses, how much drawdown you can bear in any state of the world, how much that's your risk budget, how much you can lose. Okay, and for instance, you say 10% or 5%. Well, then if you implement a dynamic asset allocation strategy, which is basically a portfolio insurance strategy with a sort of more generalized type of floor, it's like a generalized or modified CPPI, if you will. So you know that the CPPI, if you parameterize it correctly, you know that you will never go see the value of your floor, of your portfolio go below the value of the floor that you define. I'm assuming here people know about the CPPI. Unfortunately, I don't have the time to go through the whole detail of what is constant proportion portfolio insurance. So this is so what we're doing here is sort of a generalized or modified sort of strategies that will suit a particular investment, a particular investor preference. So it's of course not magic that you can cope with risk management objectives exposed. It's simply because the strategy takes the actual losses that you've suffered at every point in time, and that will determine what your asset allocation or your exposure to the risky assets that you can actually implement at every point in time. So we'll see some of the examples of how these strategies work and how and see why this is a strategy that can actually cope with risk management objectives exposed. Okay, but of course, as you know, in finance, well, David will see the details. And if you lack a deep understanding of how these dynamic asset allocation strategies work, well, you can have you can completely misunderstand how the strategy works. You can choose wrong the assets that you should try to put together. So, for instance, in this presentation we're gonna be looking at try to dispel some of the myths that are around in the market about portfolio insurance. One of them is that having uncorrelated assets is good. Okay, so having uncorrelated assets is good when you're doing simple diversification as opposed to portfolio insurance. When you're doing diversification, the lower the correlation between your assets, well, the better you are, because that's what you're trying to hope. But unfortunately, when during market crashes, you don't know how much you're going to lose, right, in advance. So that's that's the limit of diversification. Well, as we will see for a simple CPPI, well, actually having a good correlation between what is sometimes called in EDHEC language the core and the satellite, having a good correlation between these two assets is going to be actually good. I know this is a little bit counterintuitive, so I'll try to give you a little bit of intuition on that. Another myth about portfolio insurance is that like the way people try to determine the multiplier of the CPPI in practice is they basically look what is the maximum multiplier I can afford that will allow me to remain with a positive cushion. That means that means my portfolio will stay above its floor, even in the worst case scenario. Okay, so that's why they would basically say, well, in worst case scenario, before I can rebalance, I can in stocks I will see a loss of minus 20% in one day before I can rebalance. So that will be, the inverse of that is going to give me the multiplier, which is around 5. Well, what we'll see is that using the maximum feasible multiplier, feasible in that sense, is not optimal. It's not going to maximize the expected return of the strategy. So what we'll see is that the optimal multiplier will actually depend on the properties of the assets, the correlation, the volatility, and expected returns of the assets that you're looking at. And it's going to be actually lower, so you don't have to take as much risk to optimize your expected return, in fact. Another remark about that we often get at Koris is people they think about, when they think about portfolio insurance, they always think about CPPI. So I will show you that the kind of strategies that we put forward and we research and study at Koris International are quite different from CPPI in terms of their max drawdown and in terms of expected returns. So that's what I'm going to show you in a few minutes. There's also other kind of myths around what are the kind of objectives that are actually insurable. So I've seen a couple of papers in which they put forward a floor that would guarantee 100% of the performance of the portfolio over a trailing period of time. Well, what we actually find out is that this is actually a risk management objective that is not insurable. It means that you cannot cope with this risk management objective exposed, which is what is that kind of dynamic asset allocation strategies are supposed to do. So you have to be very careful you really need to understand it at a deep level, what is dynamic asset allocations, how they work. Because at the first sight, sometimes they can seem quite simple, but it's very important to know and to have some experience, which is what we have at Koris. So the first part of the presentation is a research paper, which was part of my PhD thesis at EDHEC. It's on growth optimal for insurance and the benefits of high correlation. And then the second part of the presentation, I'll be presenting comparing CPPI with sort of maximum drawdown dynamic asset allocation strategies that would limit maximum drawdown in absolute terms and in relative terms. So let me start with the research results. So this is I took this from a paper from François-Serge Lavitin. It's an EDHEC paper, another short research paper that makes a very clear point. If you see these there's two assets on the graph on the right of the slide. How many people would think that they have positive correlation? Okay, how many people think that the assets on the right have a negative correlation? Okay. Well, you probably know that if I'm asking the question is because the answer is not obvious, right? Actually, the assets on the right of the slide are perfectly positively correlated. They have a correlation of 100%. However, they have opposite trends. They have opposite average returns. If you look at the formula of what correlation is, you're actually subtracting from returns the average return. So you're actually subtracting first the trend, and then you're looking at the dependence of the returns after subtracting the effect of the trends. So when people think about correlation, they think about sort of dependence in a general way, but that can be absolutely not true. So that's why, as you will see, having a good correlation can actually be good, but correlation in the strict sort of sense. On the other hand, if you see this other, there's actually three assets there. The one in the middle doesn't have a stochastic term. The other ones are two assets which have perfectly negative correlation. The correlation between the two assets is at -1, but they have a common trend. So as we will see that we have sometimes very often we very often misinterpret what correlation really means, and we confuse it with the actual trend of the returns of the assets. I'm going to put up a couple of equations here just to define what is the growth rate. The growth rate is a quantity that is not very often measured in practice, but it's actually very important. The growth rate is simply if you will, the continuous time version of geometric return average. So when we think about expected returns, we always think about average return, which in continuous time would be like for instance in this simple Black-Scholes model, it would be mu, right? That's expected return. That's the drift of the return. But there's the actual growth rate, which is the expected compounded return of an asset. It has a relationship which is similar to the relationship that a geometric average and the arithmetic average of returns have, which is simply geometric average, or in this case growth rate, would be equal to mu minus half of the variance of the return. So if you know that if you make a buy and hold investment, well, for a given level of average arithmetic average return, having a higher volatility in the compounded return of the asset would be lower. So what really matters for investments is the growth rate of the asset, and not only the drift. Okay. So what we're going to do here is we're going to decompose the growth rate of the CPPI strategy. Okay. what people have done in the literature is to decompose the growth rate of fixed mix asset allocation strategies. So, for instance, you can think of a portfolio which has always 50-50 asset allocation. You know that in fact the growth rate of the portfolio won't be only 50% times the growth rate of the first asset plus 50% of the second asset, but the fact that you're rebalancing frequently and that you have volatility involved and correlation between these two assets will actually give you an extra term which is called the diversification premium or diversification return. This is what you're going to see in papers such as Booth and Fama 92 and Fernald, which is a book which decomposes the growth rate and gives explicit expression for the growth rate in terms of the volatilities, expected returns, and correlations of the assets composing the portfolio. So what we're going to do is we're going to do a similar decomposition of the growth rate, but for a CPPI strategy, which is quite different from a static asset allocation strategy. And we will see that actually the effects that correlation, volatility, and expected returns will have on the actual return of the portfolio are completely the opposite that static asset allocation strategies have. And if you think about it, the intuition for that is simply when you have a static asset allocation strategy, which are rebalancing constantly, okay? You're constantly rebalancing to have 50-50 on your two assets. What's going to happen if you have a lot of volatility or return reversals between these two assets is that there will be sort of a buy and hold, buy low, sell high sort of strategy. Because if you want to keep equal weights, you're going to sell the former relative winner asset, and you're going to buy the loser asset. And if in the next period there's a return reversal, so the winner asset becomes the loser one becomes a winner asset. When you're doing sort of a buy and hold, buy low, sell high every time you're rebalancing, so you're gonna get a benefit from volatility. Okay, so if none of the assets are completely outperforming the other one, you're actually getting what is called a rebalancing premium, or the diversification premium, which comes from rebalancing. So the actual expression for that, so as you see, the growth rate of a fixed mix portfolio, pi is a vector of weights. You have n assets, and pi I is the growth rate of each of the assets composing the portfolio. The growth rate of the fixed mix portfolio is the weighted average of the growth rates of the component asset plus this term which is called the excess growth rate, which is simply the difference between the average variance of the assets in the portfolio minus the variance of the actual portfolio. So as you see, the lower the correlation, the higher the excess growth rate. So it's like so that's why people have called it the diversification return or diversification benefit. So this quantity, this excess growth rate, is always positive if all your weights are positive, okay? But and it's higher for higher volatilities and higher for lower or negative correlations, as you can see from the sign on the second term. Now, well, Ray explained the intuition is sort of this. It comes from this buy low sell high rebalancing in the presence of volatility and return reversals. Okay. Now, if we decompose the growth rate of the CPPI, well, there's a way of reinterpreting the growth rate of the CPPI, but which is basically you can separate the dynamics of the CPPI into a floor process and the cushion process. The cushion process can be reinterpreted as a leverage fixed mix strategy, in which you're going to have a weight of M, so your multiplier, which would be like around 3 or 2, on your satellite, and then 1 minus M on your core. What will happen is that the sign of this excess growth rate will change. So all the effects that you were seeing on the fixed mix, on the fixed asset allocation strategy, are completely reversed. So volatility is going to be bad instead of good. Correlation is going to be good. And in fact, the differences in expected return is going to be good in this case, because you want to have a satellite asset that is outperforming as much as you can your performance-seeking asset, your core asset or your reserve asset. Okay, so what will happen? This excess growth rate is going to be negative, so that's why we call it a rebalancing drag of the CPPI strategy. So the idea here is, when you want to try, how can you apply this practically, right? I mean, if you're trying to choose a couple of assets that go well together in a dynamic asset allocation strategy, the criteria that you're going to use to choose these assets is going to be completely different than if you're trying to do some sort of static asset allocation strategy or even static portfolio optimization. Okay, so this is a crucial thing to know. So in this case, what I'm looking at here is the actual value after 5 years of a CPPI strategy and of a fixed mix portfolio with the same initial asset allocation. Okay, so the black surface is the value of the CPPI strategy. The red surface is the value of the fixed mix strategy for different levels of correlation. The one the top left corner has a negative correlation of minus 0.5, so that's like the ideal case for fixed mix, right? Because it gets diversification benefit from low correlations. And when you go to the right, when you have zero correlation and then to 0.5 and then 0.75, you can see that the actual gain from the CPPI of having a higher correlation, of course, everything else being equal, you have volatilities of 15% and 5% for the two assets. You get a lot of return from. It's actually you're decreasing the cost of portfolio insurance in this case. In fact, what you're doing there is you're decreasing your rebalancing drag that the portfolio strategy has. Okay, so one way to apply this is, well, if I have a core asset, if I have a reserve asset, and I need to choose the optimal performance-seeking portfolio, well, I know I have a criteria. What is the best asset that I can match with my given benchmark, with my given core asset? Well, I need to find a strategy that has good correlation and has a maximum expected outperformance, right? Because as we see, the growth rate of the portfolio will be m times the difference in the growth rate, so you need a lot of outperformance, but you will also need to see whether your rebalancing drag is too big because for instance, your correlation is too low with your reserve asset. Okay, so that is sort of like the first insight. So as opposed to diversification strategies, dynamic asset allocation strategies has completely different properties in their behavior with respect to the properties of the component assets. Now, another practical application of this is, now that we know specific expression for the growth rate of the CPPI, we can maximize the growth rate, right? The growth rate is the geometric average of this strategy. I already have a risk dimension to it. I already have, I need to cope with the guarantee of the CPPI, right? So you already have fixed your risk management objective. Now what we can try and see is, well, what is the multiplier that maximizes my return, right? That's sort of the most intuitive and obvious answer to it. So what people have done, in fact, they haven't looked at what is the multiplier that maximizes the growth rate of the CPPI. What people have done is, well, I have some intuition that the higher the overperformance of your performance-seeking asset, well, the higher I should put a correlation. That is sort of what this part of the equation is telling you, right? If you have more autocorrelation, well, you multiply that by the multiplier, and you get a higher growth rate. But the problem of it is that you have a negative term here that the higher the multiplier, the higher your rebalancing drag. So if you increase too much your multiplier, you're gonna get killed by volatility, right? So In fact, so this is what sort of the benchmark that we're looking at when we compare our growth optimal portfolio. So the classic CPPI will be determined by a multiplier that is usually, as I was talking at the beginning of the session, is sort of 1 minus the worst loss you can ever see on your performance-seeking asset or satellite. Okay, so if you have stocks in the satellite, it would be typically, you know, if you have if the worst return you would expect before you can rebalance is minus 20%, the multiplier would be around 5. But in fact, so there's in fact, the derivation of the growth optimal multiplier is actually quite trivial. You just need to derive an equal to and find the multiplier from here, from the equation of the growth optimal of the CPPI. Then you can find the multiplier is a function. So it increases, in fact, with the outperformance, the expected outperformance of the satellite with respect to the core. But it will also depend on this rebalancing. You know, it will depend also on the volatilities and the correlation of the two assets. So as you can see in these two graphs, what you're seeing here, the gray surfaces are the growth rate of the cushion of the CPPI. So you will see, for instance, that you can, if you increase your multiplier here in the right, you can get actually very negative growth rate of your CPPI. So you know, if you maximize, if you're trying to maximize growth, if you're trying to maximize return, it can be actually a very bad idea to just set the maximum multiplier you could ever bear. As you can see, having low volatility on the performance-seeking asset is actually quite good. The optimal multiplier and the growth rate of the CPPI strategy increases a lot when you lower the volatility of the performance-seeking asset. So, for instance, so that kind of sort of calls for, well, maybe it's good to have a performance-seeking asset with a minimum level of volatility for a given level of expected return. So, in fact, having a portfolio on the performance-seeking asset or the satellite, that can actually be something that makes sense into this. So the problem is, what are you going to use static asset allocations for? Well, you need it to create return, not to manage your risk, because in terms of risk management, as I was discussing, you don't know what you're going to get. You don't know how much you can lose. You don't know how much volatility you're going to get. However, minimizing volatility for a given level of return, if you're not killing your return when you're controlling volatility, is actually very good if you put it in a broader asset allocation strategy in which your risky pocket is going to be, for instance, your global minimum variance portfolio, and your dynamic asset allocation and your broad asset allocation between this risky pocket and your benchmark or your reserve asset that would be, you know, hedging whatever your risk-free asset is. You know, can cope with risk management objectives ex post, and you can also profit from these sort of diversification benefits on your risky pocket. Okay, so this, my message here is diversification is not incompatible with dynamic asset allocation strategies, but it should not be used for determining the broad asset allocation strategy, because you don't know what you're going to get at the end, as opposed to using dynamic asset allocation strategies in which you're going to be able to cope ex post with strict risk management objectives. So that's what I'm going to try to show you here. Here, this is a couple of examples of showing how that growth optimal portfolios can outperform the CPPI over long term. Here I'm actually, this is the first test is simply an in-sample test in which I use the whole sample to estimate volatilities and expected returns. So I find actually expose the multiplier. So it's sort of a first test. But you can actually see that there's not only a benefit from using the optimal multiplier, but also adjusting the multiplier when you re-estimate variance and correlations dynamically. So you get extra return, if you will, extra growth, if you take into account for the fact that the volatilities and correlation are actually changing over time. Same thing happens when you do an out-of-sample test. Here I'm splitting the sample in two. I'm estimating parameters, the Garch parameters for the dynamic one, or simply taking the volatility over the first half of the sample. For expected returns, I'm simply using a moving average of 10 years. And then you can see that in terms of returns, well, the three of these strategies, CPPI, growth optimal portfolio insurance, and growth optimal portfolio insurance dynamic version, have cope with the same risk management objective, right? They will guarantee, in this case, 90% of the initial capital adjusted by the return on cash. Okay, so in this case, you have simply cash as your reserve asset. In your risky pocket, you have the stock market index, and you can see that you simply get more return because that's what you're maximizing, right? You're using, and in fact, the multiplier is lower than the multiplier of the CPPI. So you're taking less risk exposure, and you're maximizing your return because you basically take into account the fact that volatility is going to drag the return of your portfolio. So if you have a lot of volatility, like in the stock market, then you don't want to drag away all your returns using the maximum multiplier you could ever use in this kind of strategy, right? So now so that was the paper on the CPPI. If you are interested to know more on the details of this paper, we have a stand here downstairs. I have some copies of the paper if you want to, look more into detail. Right now, I'm going to be talking about. The asset allocation, dynamic asset allocation strategies that are sort of more appropriate for most investors. With respect, like more interesting than the CPPI. The CPPI has got a few problems, right? CPPI has a very complicated, the problem with the CPPI is basically that it will give you a guarantee on the capital, but in terms of returns, you would only get a guarantee in terms of the return since inception. I mean, in any other horizon, you have no guarantee on the CPPI. In fact, if you run a CPPI for a long time, if you, for instance, if you have stocks as a performance-seeking portfolio, you're going to end up pretty much invested in stocks because in the long term, stocks perform, right? But what happens in the shorter term? The shorter term, if you have gained enough returns if you've got enough cushion, you can go for years and years. You can start losing money on the CPPI, and it will only stop until you're back till your initial capital, right? Which is something most investors cannot afford. You will tell you're looking at the CPPI and you're telling me, okay, listen, I'm keeping up with your promise, but for 5 years we've experienced losses that more than 10%, is more than 15%, 20%. But that's just the losses. It has a caution, that we've gained all that caution. Well, people is just not patient enough to see the stock market go up again, right? And there's no guarantee it's going to go up again anyway. So people prefer to lock in the gains that they have done over a period of time. How do you do that? Instead of trying to set a floor, which is the CPPI floor is simply K, which would be a percentage like 90% or 95%. Times the value of the benchmark. The benchmark in the first example was cash, so initial capital adjusted by the return of the interest rate, or any given benchmark, any given stochastic benchmark. It may be a long-term bond index, or zero coupon bond, or a liability hedging portfolio in the case of pension funds. So this is what the CPPI is going to do. But whatever return you're going to make over the life of the portfolio, you can lose it all over again, right? So what you can do instead is to limit maximum drawdown. Okay, how do you do that? Well, you simply say, I'm gonna try and see. I'm gonna set a limit, and then I'll see how much money I've lost from the highest point I've taken, right? And that will determine your risk budget. So this is also a known strategy in literature. Maybe it's less known than the CPPI, but this will basically put an upper bound on the maximum drawdown of your portfolio, and the mechanism of it is the same thing as it's another portfolio insurance strategy. You basically dynamically adjust your portfolio depending on how much loss you've done, how much loss you've realized. If you haven't realized any loss, but you just made money, but at some point you're gonna be limited on your exposure. every time, in fact, that you reach the portfolio reaches a new maximum, you'll be caught by the maximum allocation of the strategy, which is not, which sometimes could be around 30% or 50%, but depending on the multiplier and how much risk budget you're going to get. So as you can see, the max drawdown asset allocation strategy, the max drawdown portfolio insurance, are very different from CPPI. So the mechanism behind the way you determine the asset allocation has this, if you will, important component, which is the risk budget, which is the thing that will determine how much risk you can take. But the properties, as we will see, are very different from CPPI. First of all, you're going to have a limit on the risk exposure that you're going to take, because you want to limit the losses that you can experience over any period of time or over a given period of time. So this is, we've done a little bit, we've done a few generalizations of this maximum drawdown strategy. One of them is how we can generalize the strategy in a way that we can control the absolute drawdown of the strategy without having to use cash on the core, because that's what the people sometimes worry about. They tell it, well, listen, interest rates are very low, and we don't have much risk budget. We cannot afford to lose more than 3%, 4%. Well, in that case, you don't have much risk budget, pretty much invested in cash, right? So that's something people cannot afford. So there's ways to make generalization of this strategy in which you can use core assets that are going to be different from cash. Another generalization is to, instead of controlling the maximum drawdown over the whole period of the investment, you can, for instance, choose a specific trailing period of time. You can, for instance, control the max drawdown over 1 year or 3 years or 5 years or whatever is convenient for you. That the fact that, but again, I stress the fact here, this is only insurable if you give yourself a little bit of risk budget. If you want to lock in 100% of the gains that you make during a year, this is something that is not insurable. So I've seen papers doing this thing, so you should be aware that you need to give a little bit of risk budget to the strategy if you want to make it insurable. Otherwise, you won't be able to be sure that you cope with this risk management objective exposed. Okay, so which is I think the most interesting thing about dynamic asset allocation strategies, that actually after the fact you can actually tell your investor year after year, listen, whatever happened in the world, we've never lost more than 5%, which is what you told us to do. And on the other hand, you have the upside potential. Well, you have to know how to maximize, optimizing the multiplier, or putting a horizon that will eventually give you risk budget in a yearly basis. For instance, if you set your horizon over 1 year, you sort of decrease the constraint of the maximum drawdown. Okay, but we won't be able to have all the details of it over here. So again, most of investors see that volatility is actually not. Volatility is being very criticized as a measure of risk. So what we're trying to do here is to control max drawdown, because cumulative losses is what people actually care about, right? So the beauty of this sort of strategy is that you can cope with it exposed, and this is something that CPPI doesn't do. Again, as I was explaining. So here's an example of it. What we're doing here is, again, we're just doing the simplest case. You're doing cash against the S&P 500 over a very period of time. So what we're looking at here is that two CPPI strategies, one with the maximum multiplier, which is what people usually implement when they implement the CPPI, the CPPI with the optimal multiplier, and then a fixed mix portfolio that I actually cooked over the sample. I basically look what is the fixed allocation that would give me a drawdown of 10% over the whole period, right? So I'll be sure that my drawdown over a rolling period of 1 year will be actually 10% if I use a fixed mix allocation. And then I look at the dynamic core satellite, which is basically using a maximum drawdown floor over a trailing period of 1 year. And what you can see there on the right, but in terms of returns, as you can see, you get the best return except for the CPPI with the optimal multiplier. But this optimal multiplier, again, I use the whole sample to get this multiplier. So the CPPI is something you can actually cannot buy. I suppose instead, if you use a dynamic core satellite portfolio with a maximum drawdown floor, then, well, the return is actually pretty much the same, but you know that your maximum drawdown over a rolling period of 1 year will always be below 10%. And again, sometimes people is very surprised when I tell them that, like, how can you do that? But it's simply that you're looking at how much losses I've experienced during the year. Then I know how much risk budget I have. Then, of course, you know how much you cannot risk. That's it. So as you can see, you picture on the right here, it's a trailing performance over 1 year. So it's simply the cumulative performance of each of the strategies over a period of 1 year. The black line there is minus 10%. You can see the CPPI can show you very risky profile, even if you have here 90%. They have to cope with 90% of the value of the initial capital, right? And because they're basically losing all past gains, all cumulative gains that the CPPI is making. Well, he can afford to lose all of that again, right? Over the long run. So that's something people just cannot bear. Having drawdowns of around 67%, 40% is something people just don't bear. So you can go and sit down with an investor, tell him how much loss can you bear, and then if you control your allocation in a dynamic way, you adjust it in a dynamic way, you can actually control your drawdown to the desired level that you want. So this is coping with a risk management objective exposed. Okay, so that's the beauty of using a dynamic. So now you see the fixed mix portfolio, which is something you cannot invest in. Well, it has actually less return over the long term, because basically it's not using the risk budget in an optimal way, right? It's just basically saying I'm always putting the same amount of money on my risky asset. Well, most of the time what will happen is you basically won't have a drawdown. As we will see in the simulations, the fixed mix will have usually lower drawdown than the dynamic strategy, because it's basically not using the risk budget that has been given, right? So if you will, the dynamic core satellite is basically making an optimal use of the risk budget that the investors are giving themselves, in fact, because they are the ones bearing the losses, right? Here, what I'm doing is I do 1,000 block bootstrap simulations of the stocks and cash, and then I'm looking here at the distribution of the three strategies. So here I'm only looking at the optimal CPPI, as we saw it performs better than the CPPI with maximum multiplier. So you can see there is an important. So when you're looking at the bottom left corner, is a payoff diagram, right? Like the ones you look at when you study derivatives. So what you have here on the x-axis is the stock. There is the return on the stocks compounded over a 10-year horizon, which is the horizon of the simulation. And then on the y-axis you have the compounded returns of each of the strategies. So you can see the green line is the one on the is dynamic strategy that is ensuring a maximum drawdown of 10%. So you can see for most of the from returns from between about, you can really see there that is from about 4% a year and 14% a year over a period of 10 years for the stocks. The expected return is maximized by the strategy with the highest return is the dynamic core satellite, the dynamic strategy. You can also see there on the top left, on the top right corner, you have the returns of the strategy again. That's pretty much the same graph, but I took off the CPPI. So you can see with respect to the fixed mix strategy, the dynamic strategy basically has a higher expected return. But on the bottom right corner, what you're looking at here is the maximum drawdown of the portfolio compared with the maximum drawdown of the stocks. So as you can see, the blue dots, which are the maximum drawdown of the fixed mix portfolio, are below 10% in some cases. Why is that? Because I used the sample, the historical path, to determine the weights. But ex post, of course, the fixed mix strategy won't always, unless it's 100% invested in cash. In some scenarios, will always. You can get some scenarios in which your drawdown is going to be worse than 10%, even if you have a very conservative asset allocation. In this case, I think it's about 16% is what I got from to get the 10% drawdown over the whole sample. On the other hand, if you're looking at the green dots here, well, most of the time the drawdown is higher than the one you get on the fixed mix, because the fixed mix is misusing the risk budget. But the worst drawdown that you're getting in every scenario is always below 10%. Okay. So again, it's just to show you how much confidence you can build on investors when you have a dynamic asset allocation strategy, because in advance you tell them how much you want to lose. Well, that's something you can actually. But this is the kind of technology that is behind most structured products, right? But the problem with structured products is they're very complicated stuff, right? They usually try and do sort of combine different objectives in order to get as much fees as they can, right? But in this case, what you have very clear risk management objectives. You define it with the investment with the final investor, and then they know how you cope it. You simply dynamically make an allocation between your risky pocket and your performance, your risky pocket and your safe pocket, and that's how the dynamic asset allocation works. This is another way of looking at the simulations again. The distribution of the returns over a 10-year period on the top left corner. So you can basically see there's the returns on the dynamic asset allocation strategy are basically higher than the fixed mix portfolio with the equivalent maximum drawdown, with equivalent risk, which in this case is maximum drawdown. Again, here to top right corner, you have the maximum drawdown of the portfolio. The black line there is 10%, minus 10%, sorry. So you can see the drawdown of the dynamic strategy is always below 10%, and is usually higher than the fixed mix one, but the fixed mix one is going over 10%. So it's basically sometimes misusing your risk budget, so it has a lower expected return, but on top of that, it cannot cope with the risk management objective that it was set for the strategy. Below, we're comparing the dynamic maximum drawdown strategy with the CPPI. The CPPI will basically can have a higher expected return when stocks perform fantastically, right? We saw it here above like 16 or 15% a year. Well, the CPPI starts beating the maximum drawdown strategy. But the drawdown, of course, of the CPI we've seen, it can be, as bad as, in this case, 42%, right? So it's quite a little bit more than 10% that we're targeting with the dynamic strategy. Okay, so that was an illustration of how dynamic strategies can control for absolute drawdown, right? For absolute losses. Now, in some cases, when portfolio managers have, like equity portfolio managers, for instance, they have a benchmark, or you simply want to optimize what you're doing on your risky pocket, on your equity pocket, right, of the portfolio. You want to sort of enjoy the benefits of sort of smart betas, like the EDHEC indices portfolios or the betas on emerging markets and all that kind of stuff. Well, the problem with that is that, these strategies can beat your benchmark, which is usually maybe a bad benchmark, but it's your benchmark, Maybe a cap-weighted index, for instance. The cap-weighted index is a benchmark for most portfolio managers. But the problem with just going 100% into the alternative, right, into the smart beta, is that, well, during some periods of time you can actually see a very bad underperformance of that benchmark. Not necessarily because they lose more money in bear markets, but because sometimes during turning points on bull markets, well, the cap-weighted portfolio is actually a sort of momentum strategy, right? You're allocating more to the winner assets. So during some rally markets, like typically as we're going to see the IT market, you can have a lot of underperformance of your benchmark. So you want to try and control that. You want to limit uncertainty. That's why. So that's what we're going to do with dynamic asset allocation strategies. You're going to set a limit, a strict limit on the underperformance, the maximum underperformance of your benchmark. Okay. So what we're going to do here is it's simply a generalization that we've done of the maximum drawdown floor that we were looking at before, but in terms of the relative value of your satellite portfolio or your performance-seeking portfolio with respect to that benchmark, okay? Which is, again, I'm going to show is completely different from the classic CPPI, right? The CPPI will only set a limit on the underperformance since inception, right? But if during a period of time, during like a five years time, you're underperforming your benchmark, well, all your clients are gone already, even if you cope up with your initial promise. So what we're going to be doing here is a dynamic strategy with a relative maximum drawdown floor. I'm going to limit the relative drawdown with respect to the benchmark to 15%. Probably thinking it's quite high, but if you look at the actual relative drawdown of the asset that I'm using as a performance-seeking portfolio, it's more around 40%. So I'm pretty much cutting by more than half the underperformance of our benchmark, right? So what I'm doing here is I'm assuming that the benchmark, which you can argue about it, you can say it's a bad benchmark, but I'm assuming that someone imposed me that benchmark. The benchmark is the S&P 500 index, so the cap-weighted index, and I want to sort of enjoy I understand that there's fundamental reasons for which over the long term I'm going to have a better risk-return trade of using smart beta, such as the EDHEC efficient index portfolio, EDHEC efficient index. So I'm going to do a dynamic allocation between my benchmark, which is going to be the S&P 500, and the EDHEC risk index. Okay. So what I'm looking at here, well, you see the performance, the average geometric return of the dynamic strategy is pretty much the same, a little bit higher in this case, but it's not always the case. Pretty much very similar to the performance of the EDHEC index. The amount of risk, whether you look at volatility or maximum drawdown, is pretty much the same than the efficiency index and then the S&P 500. Yeah, but you can totally see the overperformance of the indices. Here I'm using a logarithmic scale, in fact, because if you plot in such a long sample the values of the strategies, you're going to just simply see nothing until like 3 years before the end of the sample, and then you just get these big movements in the assets, which actually cannot show you, which actually hide what's going on actually, what you're going to see during the whole sample. So as you can see, before the tech bubble, the cap-weighted index is overperforming the EDHEC index, right? What's going to happen there is, well, it's basically the sort of momentum effect that you can see in cap-weighted portfolios, right? So during that period of time, it's not that the EDHEC index is losing more money. No, it's just lagging with respect to the market. And if that's your benchmark, well, you will see that the relative performance of the EDHEC index in this case can be the underperformance can be as bad as in this case over a rolling period of 5 years would be 32%, right? So if you during a period of 5 years have accumulated underperformance of your benchmark, even if it's during a bull market, you can have a very important underperformance of the benchmark, right? I mean, in the long term, you can definitely see what is the benefit of investing in smart beta, right? You get on the long term, you know that you're optimizing your weights, but the problem is that during certain periods of time, well, if someone imposed you that benchmark, even if you know that in the long term is not a good idea, well, that's your benchmark, right? So if you have to cope with it, well, you can actually limit the underperformance with respect to that benchmark to a very precise level. You set the level at 15%. Okay, and you dynamically allocate, you can see the allocation here the brown lines in the background here are the allocation to the EDHEC index. So you see most of the time you're 100% invested in the EDHEC index, but during certain periods of time you definitely gotta get out, otherwise your underperformance just get compile and compile, and you get you probably just your investor will leave. You know, if you tell, well, you told me you're gonna overperform the S&P 500 on the long term, and then 5 years later, yeah, you should wait. You know, there are fundamental reasons why we're gonna overperform this benchmark. Well, you've done minus 30% less. It's not minus 30% loss. It's 30% less than the S&P 500, right? In cumulative returns. Well, they're probably gone, right? So you definitely need to cope with the short-term and behavioral constraints that investors have, you know, especially because most of the time they don't understand how you're gonna get your additional performance, right? I don't care whatever your source of alpha is. I just want to see it, and I don't want to get too much underperformance with respect to what I chose to be my benchmark, right? So that's what we're looking at in this strategy. And the strategy here is, I'm going to check how much am I doing with time. Okay. What I'm looking at here is the difference in performance between the S&P 500, between the EDHEC index and the S&P 500. That's the blue line, which actually you don't see because it's below the red line, which is the CPPI. And the green line is the dynamic core satellite, right? So dynamic strategy with a relative maximum drawdown floor. So what the black line there is minus 15%. So you can see you can cope with you can limit the maximum drawdown over a period of 5 years, for instance, or less, right? So that because it's the maximum relative drawdown. So what you can see there is you can always keep you can cope with a risk management objective ex post that you set ex ante, which we believe at Koris is very important if you want to build confidence relationship with your clients. So that was about it. So the idea here is I hope it's been clear that the CPPI has very different characteristics and sort of cope with very different risk management objectives than maximum drawdown and relative drawdown sort of strategies. As you can, I've also tried to sort of dispel some myths about dynamic asset allocation strategies and about the CPPI in particular, such as having uncorrelated asset is good and that the maximum feasible multiplier is the maximum is the one that will maximize your portfolio, the return of your portfolio. And then, yeah, I think the message is pretty clear. What we really think that the value added of dynamic asset allocation strategies is that you can set risk management objective ex ante and come with them ex post, which you can never do with the static asset allocation strategies. Okay. Thank you very much.